Good evening. Can you hear me? It's a pleasure to see all of you. Apologies that we've started our program a little bit late, but we tried to catch up on time. For the ladies, from where I'm standing, you all look beautiful. And to the gentlemen, you all look handsome. So good evening once again, distinguished guests, fellow CFA charter holders, ladies and gentlemen, and our partner this evening, the TDB Group. Welcome to tonight's event, Forecasting Dinner. My name is Cliff Mayaka. I'll be your Master of Ceremony. I don't earn my daily bread from being a Master of Ceremony. I'm a portfolio manager. I work with Corp Trust Investment Services Limited, a fully owned subsidiary of the Cooperative Bank of Kenya. And I'm delighted to be in your midst. At Corp Trust, I work as a portfolio manager in charge of alternative investments. Happy to see that even our president is elated having this conversation around incorporating the private funds into steering the economic growth. I believe that's what we'll be discussing this evening. And to start it off, I know we are accustomed to numbers, but today we will not be looking at numbers. We'll be looking at the architecture of our regional growth. And to start us off is I want to welcome a great leader who embodies standards of profession. He's the president of the CFA Society of East Africa. He has been a tireless advocate for investment excellence across the region. Please help me to invite to the podium Mr. John Okumu, CFA. Thank you.
Thank you, Cliff, for that introduction. I've never been described as tireless before, so I'll take it today. The president of the Trade and Development Bank Group, Mr. Admasu Tadese, Governor of the Central Bank of Kenya, Dr. Kamau Thuge, industry leaders, distinguished guests, ladies and gentlemen, good evening. On behalf of the CFA Society East Africa, it is my honor and privilege to welcome you all to the inaugural CFA Society East Africa Forecast Dinner 2026, jointly hosted with the Trade and Development Bank Group. We're delighted to gather here at TDB Tower for an evening of insight, dialogue, and collaboration. A brief background on the CFA Society East Africa. So we're a member society of the CFA Institute, which is a global association of more than 200,000 investment professionals. It sets the standard for professional excellence and ethical conduct. The CFA Society East Africa brings together close to 300 investment professionals as members across Kenya, Uganda, Tanzania, Rwanda, and Ethiopia. Our members cut across industries, most of whom are in this room, and include corporate executives, CEOs, CFOs, portfolio managers, investment bankers, analysts, corporate finance professionals, academics, and regulators, among others. Our mission as the CFA Society East Africa is to lead the finance and investments profession in East Africa by promoting the highest standards of ethics, professional excellence, and education. We are committed to advancing the interests of investors and the broader public by fostering a culture of integrity and transparency within the financial sector. And we do this through a range of initiatives. Professional development, which is where we provide ongoing learning opportunities, including seminars, workshops, and conferences, to ensure that our members remain at the forefront of industry knowledge and best practice. Ethics and advocacy, where we champion ethical behavior and advocate for sound financial regulation and governance, working closely with policymakers and industry stakeholders to strengthen our markets. Community building, where we create platforms for networking and collaboration, such as today, connecting professionals across the region and supporting the next generation of finance leaders through mentorship and outreach programs. Thought leadership, where we contribute to public discourse on key economic and financial issues, leveraging the expertise of our members to inform policy and drive innovation. Tonight's forecasting dinner is a flagship event in our calendar. It's the inaugural event, meaning it's the first of its kind in the region. We will hear from leading voices on key subjects such as the economic outlook, the challenges of sustained growth under constraint, critical issues of risk, capital, and confidence, as well as a panel discussion focusing on how to build resilient capital markets and foster regional integration. I welcome you all again to listen and engage with the discourse of today. I hope that the insights and connections made today will inspire action and innovation and strengthen our collective capacity to navigate uncertainty and seize opportunity. I once again wish to thank the TDB Group for hosting us here today and their continued partnership. I want to thank in advance our speakers who will be speaking today, our sponsors, our supporters, and you, the delegates, for making this event what it is. Thank you once again for joining us, and a good evening.
Thank you, John. He's given us the professional perspective. I think we need to move a gear up, and to lead us into this session is a person who is known for, you can say, is the engine of regional development by the virtue of working with TDB, a bank that is synonymous with regional development and integration. We are honored to be in this magnificent TDB tower. Under his stewardship, the TDB Group has become a cornerstone for regional integration and trade. Ladies and gentlemen, please help me in welcoming the President and Managing Director of the TDB Group, Mr. Admasu Tadese.
Thank you very much, Master of Ceremonies. Dr. Kamal Thuge, Governor of the Central Bank of Kenya, Mr. John Okumu, President of CFA Society East Africa, Professor Victor Murende, Executive Director of the ERC and a former governor on the Board of Governors of TDB, financial industry leaders present, distinguished guests, investment professionals, TDBians, a very warm welcome to you and good evening. We as TDB Group are very pleased to be hosting this economic forecasting dinner for 2026 in the same spirit of numerous engagements we've had with different CFA societies here in East Africa, but also elsewhere in the region, in Mauritius, but also in New York. And in the same spirit that we've hosted some of you for fund managers events here and nearby Nairobi. For an African MDB like TDB Group that has a long and rich history with institutional investors, collaborations like this are quite important to us. We have common cause in the matter of making African institutional capital work smarter and more dynamically for the benefit of our burgeoning financial sector across the continent. And as we know, we're in an age where African financial institutions have a much bigger role to play in bridging the gaps given what's happening globally. Tonight, we are gathered to reflect on the trends shaping the macroeconomic environment and investment market drivers for East Africa. We'll hear more insights, as we've been told by John. But we can be cautiously optimistic about the overall economic conditions that have continued to improve for our region and the continent at large. Those of us who follow the statistics of growth, economic growth in Africa now for the first time has become the leading engine in the global developing world, slightly ahead of Asia by a few points. Not a whole lot, but at least optically we've exceeded the region that's been the real driver of development worldwide. And we happen to be sitting here in East Africa, and those of you who also follow the East African statistics, for the first time, East Africa has really pulled far ahead of other sub-regions of the continent. Not only are we in the 5 to 6% range of growth, but we have several of our countries in East Africa that are in the high single digits. And so it really bodes very well for the opportunities for us to transform our economies, create the jobs, and do all those very important development interventions. Our growth is driven not just by the diversification we've always enjoyed in East Africa, but it's also very much a reflection of bounties that are coming through from the resource endowments that are beginning to manifest in our region. And we as TDB are closely associated with some of those very exciting developments. We all know about the oil and gas, countries like Uganda, Mozambique, of course, Tanzania. South Sudan has always had it. There's also gas now in Ethiopia. There's mining that's coming up nicely across the region. Countries historically were not known to be resource-rich countries are emerging as very interesting resource economies as well. And so this will give additional boosts. But of course, value addition remains critically important, and we're seeing important industrial investments coming into various countries in the region. So as positive as all of this is, it remains true that we must be vigilant and particularly defensive in this day and age. There is a great deal of fragmentation. We know what's happening with geopolitical complexities and the uncertainties in trade policies. And we also, of course, starkly aware of what's happening with official development financing from the G7 countries that has dropped very sharply. I was just in London and Paris last week, and some of our historic partners were telling us how bad it is. You're talking about more than a 50% drop. It's pretty sharp. This is why we have to make African capital work much better than ever before. And so, yes, apart from doubling down on our own financial sector and its architecture, we need to do what some of the central banks have been telling us for some time. We need consolidation. We need our banks to be stronger and bigger. The capital bases need to really catch up with the big banks we see in Southern and Western Africa, as well as North Africa. So there's a number of interesting reforms coming through in East Africa where we're going to see much more consolidation coming through in the banking sector. And for TDB, that is very welcome, because we ourselves have been thinking very much around how we're going to grow and get more sizable in order to be much more relevant and to be able to fill some of the gaps that have emerged. And in this regard, let me just say a word or two about TDB Group, since we're here in TDB Tower. Once upon a time, we were just a bank. Today, we are a group with a very strong asset management platform. We're very proud that many of you have been very important players as investors in some of our successful funds that have operated out of Mauritius. We have a 6-year-old fund that's getting close to a $500 million mark that's been generating consistent returns of close to 10% in US dollar terms. Healthy diversification, very low NPLs. Many of you have ridden that wave. And some of you have also ridden the wave of the opportunities we created in the TDB Group capital structure itself. Professor Vincent, you had been a shareholder for well over 5 years, and you also enjoyed a very good ride there. Healthy dividends coming through until some global stakeholders told us that we were too accommodating and we shouldn't have as diverse a mix of shareholders in the bank itself, which we have, of course, done, but we have made sure that our asset management space has grown in scope. We today have not just one fund, We have not just the 6-year-old fund, we have a medium-term fund that was launched last year, generated 10.2% last year. We have an export development fund, 2 of them for 2 countries, for Angola, for Ethiopia. We're very actively working on supporting Kenya with its infrastructure development fund, which is an exciting new development here. We're also working on a number of advisory mandates to support, again, sovereign wealth funds, not just here in Kenya, but in other countries like the DRC and elsewhere that really want to tap TDB talent and TDB capabilities to ensure that their sovereign wealth funds are going to be operating in a very smart way. Apart from our asset management platform and of the various funds we have there, we also have TDF. Trade and Development Fund is a concessional fund that makes selective grants and concessional financing for interventions, projects, and programs that cannot be funded from a banking or asset management platform. And we're very pleased that today we have matured as a development finance group that can begin to offer concessional financing and grants. And this is something that is quite young in our group. It's about 5 years old, but it has really helped us strengthen our credibility and our positioning amongst the global development finance industry. And today we count not just the World Banks of this world, but various pension funds and endowments and foundations who are putting very fit-for-purpose soft funding into TDF. And so that is, again, part of TDB Group. We have built out our stable. We have about 6 different entities within the group that do different things. We'll be launching a green housing fund later this year. We'll be inviting institutional investors into that opportunity. And the COP32 will be taking place here in Africa next year in 2027. We intend to launch an e-mobility fund there as well to help accelerate the adoption of electric vehicles and related charging infrastructure to accelerate the rollout of that type of climate finance, transportation solutions. I'm very pleased to salute some of the institutional investors here with us today that have been successful investors in some of our funds. I see we have Sanlam and Jubilee. I see we have Old Mutual and Britam. I see we have CIC, Zepri, Dry Associates, ICA Lion, and NCBA. That's a handful of institutional investors. That represents a very sizable chunk of the investor community that's worked very well with us over the years in our asset management space. And I should recommend that we all salute one of the driving engines behind these partnerships with institutional investors here. It's a very vigorous lady called Umulinga Karangwa, who most of you don't see the end of her calls because she's always chasing you for all sorts of things. So Umulinga, well done for all that you do for us. We have a beautiful story to share with you on what your investment has achieved by way of development impact in our funds. We've supported various sectors. We've supported SMEs in general, but also women-led SMEs, youth-orientated SMEs. We've supported vaccine manufacturing plants, including modern technologies such as mRNA technologies. We've supported all manner of sectors, including some infrastructure sectors as well. The banking business itself, which is the dominant vehicle in the group, very successfully has supported infrastructure that enables trade. We financed rail, we financed ports, dry ports, water ports, airlines, airports. We'll soon be very actively working on some of the ports here in Kenya. It's premature to say, but you'll be seeing TDB very active raising financing for some of the new port initiatives here. I don't want to say which port, but anyhow, just to excite you and tell you to watch the space. We have a beautiful track record here in Kenya. We did some very exciting innovations recently, as some of you will know. Set up some SPVs, built strong partnerships with Kenyan banks and institutional investors to what's known as Project Oak that supported the construction sector to get back on track. We were very instrumental in working closely with the Kenyan government on the G2G fuel solution that helped contain costs at a time when fuel prices were going down. Again, we worked very closely with KCB, several leading commercial banks here in Kenya. Partnership has always been the way of TDB Group. And that is why, as a regional institution, we are always reaching out to see how we can synergize, scale up together in order to address all of these big gaps that we're all trying very hard to fill. With no further ado, I thank you all very much for seeing TDB as a strong partner here in Kenya and East Africa. We look forward to doing more with you in the months and years to come. And Governor, I know you've now also joined many other central banks to become an important stakeholder in TDB Group. I'm very pleased that the global stakeholders have not told us that central banks are not good enough to work with TDB. So at least, even though some have had to migrate out of our balance sheet, central banks are still considered to be very fit for purpose. So you still have the halo over your head, Governor, so we'll still call you Governor. Thank you very much.
Thank you, Mr. President. Another round of applause for Mr. President. Thank you for letting us know who TDB is and the role that you play in the economy, not only just in Kenya, also within the region. Now for the moment that we all of us have been anticipating to listen to our guest speaker. Just before I introduce the guest speaker, I just wanted to say that today morning when I was trying to Google and understand what is forecasting, I came across this definition that forecasting is essentially trying to tell what will happen and then later explaining why it didn't happen. But tonight we have the privilege of hearing from a man whose hand is in the actual pulse of not only the Kenyan economy, but also the region because of the role that Kenya plays in the East African region. He's here to help us understand how financing the future moves from a boardroom concept to a national reality and also a regional reality. Ladies and gentlemen, it's my absolute honor to invite to the podium the Governor of the Central Bank, Dr. Kamau Thuge.
Thank you very much, Mr. Mukaya. But I think the moment that the people are waiting for is dinner, not this presentation. Mr. John Okumu, Mr. Admasu Tadese, the Managing Director of Trade Development Bank, my friend Victor Morinda of Executive Director, AERC, other members of the CFA Society, East Africa, and the TDB leadership team, distinguished guests, ladies and gentlemen, good evening. Let me thank you for inviting me to deliver this inaugural policy and markets keynote address at this year's forecasting dinner, jointly hosted by CFA Society, East Africa, and the Trade and Development Policy Group. I'm happy to note that this forum brings together senior policymakers, development finance leaders, and private sector executives across the region with the objective of taking stock of where we are and, just as importantly, where we are headed. I appreciate the opportunity to share my perspective on the theme, monetary stability, market confidence, and capital flows in a changing global environment. The theme of this forum resonates well with the successful journey that the Central Bank of Kenya in implementing appropriate measures and reforms to achieve and maintain macroeconomic stability and support market confidence. As you are aware, about 3 to 4 years ago, the Kenyan economy was faced with multiple external as well as domestic shocks. And the combined impact of these shocks was a high rate of inflation, The shilling exchange rate was virtually depreciating on a daily basis. We depleted our level of international reserve, trying to defend our level of the exchange rate. And the foreign exchange market became dysfunctional with firms. Is there another one? Yeah, it became dysfunctional with the firms unable to get the foreign exchange that they needed for imports, or they were not able to get forex for repatriating their dividends. And in short, we were in an unstable macroeconomic environment with very low investor confidence. To restore macroeconomic stability and investor confidence, the central bank tightened monetary policy very aggressively. It also implemented several key reforms in the monetary policy area and in the interbank foreign exchange market. And some of these reforms included the introduction of a new monetary policy implementation framework, which was based on inflation targeting. We also introduced an interest rate corridor around the central bank rate to strengthen monetary policy implementation, as well as the transmission of the Monetary Policy Committee decisions. We also introduced the Kenya Foreign Exchange Code for commercial banks to strengthen and promote the integrity and effective functioning of the wholesale foreign exchange market. We also introduced the electronic matching system in the interbank foreign exchange market to promote a transparent and accountable price discovery mechanism. And finally, we unified the parallel exchange rates, whereby the central bank was quoting a different exchange rate from that quoted by the commercial banks. Further, to strengthen the resilience of the banking sector, and I think Tadesse referred to this, we raised the minimum core capital requirement for commercial banks from 1 billion to 10 billion, and that this was going to be undertaken within the next 5 years to up to 2029. We just finished the first year, last year, and the capital requirement then was 3 billion. This year we expect another 2 billion to 5. And of course, the intention really is to have stronger banks. And again, also what Tadesse mentioned about consolidating of the banks to make them more resilient, stronger, and more competitive. Further, in August of last year, we introduced the revised risk-based credit pricing model for banks with the aim of improving the transmission of monetary policy decisions to commercial banks' lending rates and enhancing transparency in the pricing of loans by banks. And the new pricing model will be fully operational beginning March of 2026. Now, I'm very excited about this new framework, and so far, the Monetary Policy Committee has reduced the CBR by 425 basis points. We started easing monetary policy in August of 2024. And since that time, we have reduced the CBR by 425 basis points. In contrast, the bank's interest rate has only reduced by 240 basis points from a peak of 17.2% to 14.8%. The rate for end of January, I think, was 14.81. For the end of December was 14.82. So the decline is not even a much of a decline. And so introducing this new framework is what I think will really have a very strong impact. The transmission to commercial bank lending rates will be direct and immediate. And I'm sure you have seen the adverts in the newspapers from banks saying that they are going to reduce their lending rates in line with the reduction in the CBR. And essentially, what we've done is the formula for adjusting rates is what is KESONIA, and KESONIA just stands for the Kenya Shilling Interbank Overnight Average. It's very much like the SONIA in the UK, very much like the SOFR in the US. And essentially what we now have is it's a common framework, it's a common reference rate for all banks and for all variable rate loans that are denominated in Kenyan shillings. So every bank and every loan has the same base, the same reference rate, which is KESONIA. But we have also, as I said earlier, we've also introduced a new monetary policy implementation framework, which ensures that we are able to intervene in the interbank market to make sure that that interbank rate tracks the CBR rate very closely. And so that's why some banks have chosen to use KESONIA as the base, others have chosen to use the CBR as the rate, because both of them move in the same direction and they are virtually identical. So when we go forward and we lower the CBR, we want to ease monetary policy and we lower the CBR. Let's say, for example, our next meeting of the committee will be in April. By that time, all banks should have transitioned their loans to the new framework. And therefore, when we meet and we make the decision based on the available data then that we need to ease monetary policy further, the moment that we lower the CBR, everybody's loan the following day reduces by the same amount that we have reduced the policy rate. And so this divergence between where we have reduced the policy rate by 425 basis points and the commercial banks are reluctant to lower their rates, we want to be able to eliminate that so that there's a one-to-one reduction in the policy rate and in the lending by the commercial banks. So these policy measures and reforms also supported by the liability management of Eurobond debt have restored and sustained macroeconomic stability. Inflation has declined from a peak of 9.6% in October of 2022 to just 4.4% in January of 2026. It is expected to remain low in the near to medium term, supported by appropriate monetary policy, stable energy prices, and continued stability of the exchange rate. By the end of tomorrow, we should also be getting the inflation data for February, and I'm pretty much convinced that inflation is under control. The core inflation, which really is what we worry about a lot, because that responds to aggregate demand, and that is in the region of 2% to 2.2%. And I think as long as it's there, I think that gives us some policy space to be able to bring down interest rates a bit more, given that we have some output gap and we are able to increase aggregate demand without causing inflationary pressures. So of course the tight monetary policy stance had a negative impact on credit to the private sector and also on economic growth. And therefore, with macroeconomic stability firmly established, the MPC Monetary Policy Committee then began easing the monetary policy as I just described. And as a result, the bank interest rates did decline, although not as much as we would have wanted. And the growth in credit to the private sector increased from minus 2.9% in January of 2025 to 6.4% in January of 2026. My expectation is that this growth will accelerate this year, because average interest rates this year definitely will be lower than the average interest rates of last year. So Kenya's economic growth has also strengthened, reflecting the resilience and diversified nature of the economy and, of course, the supportive macroeconomic environment. We expect real GDP growth to pick up to 5.5% in 2026 and 5.6% in 2027 from an estimate of 5% last year. And this strong growth will be underpinned by industrial sector, resilient, the industrial sector, especially the construction sector. That has been growing very strongly in the last year. The year before was very bad. There was a contraction. But last year, with the payment of the pending bills, especially in the road sector, we have seen an acceleration in value addition in the industrial sector, and we see that as a driver of growth in this year. And of course, with the expected good rains in the long rains season, we also expect agriculture to do well, and then also finally the services sector to do well, again responding to lower interest rates. So the prevailing macroeconomic stability has also led to improved investor and market confidence and increased capital flows. For example, portfolio investment inflows to Kenya were estimated to have increased from $1.3 billion in 2024 to $1.8 billion in 2025, while foreign direct investment inflows increased from 0.8 billion to about US 1.2 billion during the same period. We have also seen increased foreign investor participation in the Nairobi Securities Exchange, further underscoring foreign investor confidence in the economy and reflecting the improved macroeconomic environment. Moody's upgraded Kenya's credit rating in February of 2026, following last year's upgrade by Standard & Poor's. So these financial inflows have exceeded the current account deficits, resulting in substantial overall balance of payment surpluses and a very strong build-up of foreign exchange reserves. And currently, the CBK foreign exchange reserves stand at 12.6 billion, equivalent to 5.4 months of import cover, and continue to provide adequate cover and buffer against short-term shocks in the foreign exchange market. The prospective privatization of KPC, Safaricom, and recent acquisition of shares of NCBA by Nedbank will further add to the strengthening of reserves. Now, this 12.6 billion does not include our most recent disbursements of Eurobond proceeds. As you know, we went to the market and we got 2.25 billion of dollars, 500 of which is for liability management for bonds falling due in 2028 and 2032. And the rest is for the budget, and that will also come to build the reserves of the central bank. So when we take into account all that and all these other privatization receipts, we are expecting a very strong, healthy position of international reserves that will be able to help us address any adverse effects of shocks that might arise from a fluid global environment characterized by geopolitical tensions and uncertain trade policies. And should these shocks materialize and international oil prices, for example, rise sharply, and all our exports are curtailed because of trade policies, restrictive trade policies, we are now in a position to manage a very orderly and smooth adjustment of the exchange rate. And this will protect the gains that we have so far achieved in stabilizing the economy. And our intention is really to have such a strong position in international reserves that nobody thinks that there is any possibility that they won't get a foreign exchange when they go to a bank, and not only get foreign exchange, but get as much foreign exchange as they want. And I think once we achieve that position, we should see just stability in the foreign exchange market, stability of the exchange rate. And I think that stability is good for the economy. It's good for exporters. It's good for importers. Importers were not very happy when the exchange was 160. They are very happy now that it's 129. And of course, exporters were very happy when it's 160. They're not so happy when it's 129. But having said that, I think I would add that I think we are in the right position, right exchange rate. The balance of payments is fairly strong. It's very possible that the exchange rate could have appreciated even more, and that would have hurt the exporters. And for sure, we don't want to hurt the exporters. I think the exporters are important for future growth. And of course, importers are happy where it is. They'll be happier if it was to appreciate more. And of course, also at that level, the central bank has been able to build reserves to the highest level that it has ever had. So I think it's a kind of a sweet spot, and I believe that that's going to continue going forward. So as I conclude, the CBK is building on these gains and reforms to safeguard the prevailing macroeconomic and financial stability. The CBK will continue to build buffers in foreign exchange reserves and implement appropriate policies to sustain macro stability, investor confidence, and sustainable capital flows. So lastly, let me once again thank the CFA Society East Africa and the TDB Group for inviting me to this forum and for your leadership in convening the region's market community. And I wish you all insightful exchanges this evening. And I thank you very much.
Thank you, Governor. Thank you. Thank you once again. Another round of applause to the Governor. I personally applaud the efforts that you put at the Central Bank of Kenya in terms of stabilizing the shilling against the dollar, which you did mention in your presentation, and also in terms of the Kesonia framework. We hope that now there'll be quick transmission of the monetary policy to the general economy. Thank you for the big picture and giving us a macro level roadmap on how we'll navigate this coming year, the purpose of why we are here tonight. Moving on to the next set of presentations, I'm pleased to welcome Professor Victor Murendi to take us through the technical address on. Thank you, Karibu.
The president of the CFA East Africa, Mr. John Okumu, the group president of TDB, Mr. Dumasu Tadese, the governor, Central Bank of Kenya, Dr. Kamau Thuge, friends I see around, quite a number of them, distinguished ladies and gentlemen. Let me thank CFA East Africa and the TDB Group for inviting me here to share some ideas with you and to participate in this great gathering today. When I received the invitation letter from CFA, it had the words economic forecasting. I run around the room because economic forecasting is something that I've enjoyed doing for the last 20 years. So I could think, okay, what are they looking for? Are they looking for good old ARIMA? Are going to look for the new techniques of forecasting where you can forecast around the corners? Are they looking for anticipation? Are looking for forecasting Chicago Board of Trade indices? But then I realized that they want me to cover an element that is also very relevant here on looking at the growth patterns and the policies that can shape growth in this region and in Africa. But I was also very delighted just now to get the intervention and the good news from the TDB Group President, Mr. Dumasu Tadese, on how the TDB has performed very well, and also to mention that TDB is a board member on my board at the RC. So there is kind of a mutual connection with TDB. And I'm delighted it is actually scaling up and expanding the outreach on and footprint on the African continent. I was also ecstatic and enthralled to hear the coverage from Central Bank Governor, Dr. Kamau Thuge, on the policies and progress made in Kenya as an example of the progress in Africa. And between the presentation by Mr. Dese and Dr. Kamau Thuge, I think most of my work is done. So I may as well just do 2 minutes and then sit down. It was important to see the traction on monetary policy by CBK. Those achievements are not trivial, and they don't happen in any country in Africa. I was also very delighted to hear the emphasis the governor put on the interbank market, the role of the interbank market in adjoining the prices in the economy. And I started reminiscing, right there sitting there, reminiscing that the first study on the interbank market in Africa was done on Kenya. And on Kenya by none other than the speaker here. And and joined it also with my good old friend Samuel Tiriongo, where we had to take almost hour by hour transactions data from across all the Kenyan banks and try to tease out actually which are the banks at the periphery, which are the banks at the core, which are the banks that influence the formation of the interbank interest rate that then correlates with the central bank rate. And so this stability you see in Kenya, especially on the building of reserves, is a judicious effort not only by the governor, but also by his team, which is seated there, and I can see Professor Mudida, his work is doing on I think on Friday we were talking about exchange rate misalignments. So well done both TDB and CBK. I will cut short my presentation. I think I was ambitious. I possibly had about 30 pages, but let me say, next, please. About 30 slides, but just to say, I come from the RC, the premier capacity building institution for Africa since 1988, and I think that almost here I can see quite a large presence of RC, and we look forward to working with the institutions here, especially now that we have enrolled a 10-year development strategic plan, a renewed RC for Africa's new development priorities. Next. So in an overview of the economic conditions for Africa, it's always good to benchmark on the global developments. But actually, the two previous speakers have already covered this. We are looking forward to an upbeat global economy. Also, we are looking to a higher growth in Africa, 3.8 for 4.1% in 2026, with a great stabilization occurring. We also look at maybe less commodity exposure, addressing some countries and especially fiscal authorities addressing debt challenges. And here is a narrative. I was, I think 2 weeks ago, participating in this, the debt and national planning coverage for Kenya. The narrative is basically, yes, debt could expand. And there is no problem with that. It all comes from the bond theory that underpins the debt. As time tends to infinity, the value of the principal is zero. It is whether the countries can actually borrow to be able to grow, to expand. And so I think that's a very important for Africa. Exchange rate stability, I think that is very stable. And then, of course, the structural changes. We have had a mention of unemployment, jobs, skills. That's a big challenge. Next. So benchmarked against the global outfit, the growth in Africa is reassuring. It is positive, and that's the way we should look at it. Even when we are looking at the financial prices in particular, interest rates and exchange rates. Forecasting 2026, we see a stable interest rate path. We see stable bond yields and foreign exchange outlook. We see African currencies, the Kenyan shilling moderate, Nigeria volatile, South African stable. So that's a very good indication. And the region, we find stable again, currencies recovering from the previous period that had a lot of shocks. Next. Central bank policy rate, which the governor was mentioning, again, we see great improvements. And now in this analysis, we are benchmarking on the big global and the OECD countries to the European Central Bank, Bank of England, People's Bank of China, because of the role of China in Africa now. That is something we have to watch at the same time. But in general, we don't see any big worries of benchmarking African economies, especially Kenya and East Africa, on the global benchmarks for interest rates and financial prices. And that's, of course, consistent with the interest rate parity conditions, covered or uncovered. Both conditions are fulfilled in this analysis. Keep going. Next. Near-term interest rate. Next. That's covered in the what I've mentioned. Next, please. Yes. Now, we know these are positive developments, but we should not forget, even for one moment, as we plan our policies, we should not forget about the global shocks that have been impacting on African economies. You can go back to 2020, you can bring on board the global financial tightening after COVID. You can think of the ongoing Russia-Ukraine war. You can think of the climate shocks, the ongoing climate shocks. These are real. So in other words, these shocks have to be integrated into the framework that we use for designing a monetary policy, fiscal policy, and other policy that can drive growth in African economies. Next. But it is the shifting of global geopolitics that is very difficult to hedge against. The tools of trade we have, especially in economics and finance, can be able to enable us to be able to forecast and hedge against the other shocks. The geopolitical one is a little bit tricky because we are looking at how competing economic growth, the vulnerability of the global south, the vulnerability within the global south of African economies, and in particular of the East African economies. That is a challenge, but the challenge has to be tampered with the fact that multilateral institutions sometimes get weak in intervention. Then we have to look at some of the investment patterns. In the case of the African Union, the opportunities that present themselves in the African Continental Free Trade Area, especially on trade and investment, bilaterally, in a gravity model that we can use for this purpose. Next. These are some, now, the analysis here is take the geopolitical landscape globally, okay, and to argue that even if actually that's stabilized, we have our unique Africa-centric global landscape, regional instability, fragility of some economies, political tensions, debt diplomacy trends. That's particularly important. And the onus is on us as African countries and African professionals to see how we can modify that angle, because that is separate away from the global trends. And that's why we put aside to say that even if the global stabilized, we have to ensure that we're stabilizing on the regional specific imperatives. Next. So East African is vulnerable to global shocks. Four main ones: rising debt stress. But as I mentioned, it is not the debt to GDP ratio. No, it is actually the amortization, the servicing that matters. The soaring inflation, mainly from food and energy, but others can be controlled. The food insecurity. Yes, we have a phenomenon. For most of us who have a background in economics here, the ratchet effect in economics since 1945 was applied to two dimensions: wages. wages are notoriously inflexible downwards, the downward rigidity of wages. The second was interest rates, especially spreads. Okay, they are notoriously rigid downwards. And I think the governor mentioned some of the best. He does his best to lower the CBR. The banks may not follow. And I think the trick there is about the spread, and especially the risk premiums that banks are factoring into the pricing of the loan. It's just a formula that into the risk premium. The risk premium goes down, then of course the interest rate. But now we have a new phenomenon, apart from the two we have had for 60 years: wage rigidity, sticky wages, and also sticky interest rates. The phenomenon is food prices are not going down globally. This phenomenon is new. Food prices are a big concern. And for investors here, we're investing in the food agriculture industry, as the World Bank is now unlocking, has established what is called AgriConnect, a new compact for supporting farmers and others. The food prices is a big challenge and is a phenomenon that we have not had before, which is a big shock. And we as the ERC are trying to look to decompose in terms of the commodity ranks, trying to decompetition, which food prices are more rigid, which food prices are dependent, and which prices affect the poor or the vulnerable. Constrained fiscal space is a problem that I think can be dealt with in terms of looking at procyclical macroprudential policies for that purpose. Next. Yes, this we do comparative fragility. We have Egypt, Kenya, Rwanda, but I think the previous presentation have mentioned about how Kenya is performing very well as indicated here. Next. Resilience. So I was supposed to talk about the country resilience. So here we did the country resilience profiles of some of the African countries. Rwanda demonstrates strong resilience with high capital adequacy ratio and lowest NPR. It is as if actually the governor of CBR anticipated this, and therefore that's why they're raising the buffer. All right, that's a move in the right direction, by the way, I should say. And then, of course, Egypt is showing some improvement in asset quality, but declining NPRs. And of course, Zambia then has some of the issues in asset quality. Next. Policy choices. What will the policymaker do in terms of basically of building resilience? Because building resilience ensures that growth can remain on its trajectory. So even if you did 1 million experiments of the growth potential and did forecasts, okay, it would be this whether the economies are becoming resilient that enables the growth forecast to remain on track. And that's why. So 4 main choices: strengthening regulatory frameworks and data harmonization and monitoring, developments, which will include the performance of the private sector, the performance of investors, the performance of other professions. Targeted capacity building, we RSC come in there. Addressing sector vulnerabilities, especially those sectors that are highly vulnerable, including tourism, trade, real sector, and this particular stage, mining in Africa. Next. But the 3 ones that come out very vividly is the role of the central bank and its dependence. Okay, political fragility has been associated with reduced central bank independence. This is established for Africa. Fiscal consolidation through the Consolidated Fund, and then financial supervision, and that's where the benchmark comes in. The mention very clear and very helpful. Next. I know I'm remaining with 3 minutes. Yes, that's the one. That's the one. Any attempt to build financial resilience that can guarantee, actually it's a benchmark. It's like an alpha, okay? It's that you are starting with a benchmark. Others start from 0. Some countries will start from 0. But once you have a mechanism for resilience, you start from 2. For example, 2% of growth guaranteed, which many OECD countries can struggle to achieve. But in Africa, it shouldn't be a problem. That all can start 2% growth. And then what happens between 2% and 9% is on the policies you adopt. This is particularly important. In other words, no country with that mechanism can fall below the zero growth. That's contracting or regressive. It won't happen. And the policy framework would involve the central bank actions, digital direction, leveraging on the digital potential of the African continent, regional cooperation, regional reforms, risk sharing. Next. Global economic outlook we have covered. Next. Africa's economic outlook positive. Next. How do you proceed? And this is the quandary for most policymakers, whether fiscal or monetary policy, whether macroprudential, gradualism, where you proceed step by step, or shock treatment, where you can stand and announce that this is the policy now, you're going to follow it. My money is on gradualism. Unless a country is recovering from war, okay, if I'm taken to South Sudan next year and the gunners have stopped talking, then I will do a shock treatment. There is no doubt about it. Or any of those, I'll do a shock treatment. Okay. And I have been there. I was in Yemen when North and South, the guns were flying, and all of a sudden, as soon as on my third month on the job, the guns stopped talking. And we had to do shock treatment to make the central bank now operate and the commercial banks to follow. But meanwhile, for the rest of Africa, where there is economic, there is no political fragility, it has to be gradualism, whereby in the short term, you maintain stabilization, credible disinflation policies, targeted sector support. Yes, subsidies for manufacturing have to be in place. If you said so 10 years ago, they would think you're a crackpot. Okay. But the recent advances in industrial policy, we have had a whole week of industrial policy last week here in Nairobi. Industrial policy means interventions, selected interventions to unlock some SMEs and other industrial output to actually work. Encourage capital building during profit. That's the short run. But before you start the short run, you must have a 10-year focus, so that you know that in year 1 and year 2, you are in that stabilization. And in a steady state, in year 10, that's what you achieve in the long-term integration. And my long-term integration from West Africa would be one East Africa, one money. Thank you. Thank you.
Thank you, Professor, for sharing us the technical and research perspective on how we can remain resilient as a region and also as a country. The next presenter will be giving us insights from the private sector. Please help me in welcoming the Managing Director of AR, Mr. Justin Kosgei.
I think I will write on all the protocols already observed. So good evening, everyone. Good evening once again. My name is Justin Kosgei. I'm the Group CEO for AR Insurance. And I'm excited to be here today to just give a few remarks to the CFA Society and all the guests here today about, I think I've been asked to talk about risk, capital, and confidence. But I think I'm already overwhelmed by what has already been presented by the central bank governor. I think I should have been told that the house is going to be very powerful. The professor and I think all the CFA charter holders in the house. I'll be glad to share a few pointers. So mine will be to share more from leading a business perspective, and more of this I think are not really new to you because you're experts in risk management, capital allocation, and investments. And a lot has already been said, so you'll find some concurrence. So as I reflected on the topic that I've been given, risk, capital, and confidence, I realized something simple but profound, that these are not just financial terms, they are human terms. They generally describe how societies function, how markets behave, and ultimately how us as leadership is tested. And nowhere is that more evident than during uncertain economic cycles, which we have all seen and have been described. I'll just give maybe the next slide. I have some slides which have no significant data like the rest of the other slides that have been presented, but mine will just be to show a few things. I think we'll go to the next slide. I'll start with a small story. I think you must have heard about it. I think it's related to how to manage uncertainty and risk. In 1911, there was a guy called Amundsen and Scott. Two teams set out for the South Pole, and these two teams were both capable. They were both very ambitious, and they both believed they were prepared. One team was led by Ronald Amundsen, and they advanced methodically. He relied on tested systems. He built redundancy into his plans. He progressed in disciplined, predictable increments. Possibly that's what Professor talked about, gradualism. And on the other side, there was another guy on the left, Robert Falcon Scott, who relied partly on untested technologies. He stretched pace in favor of in favorable conditions, and he assumed that the environment would always cooperate. So the first guy, Amundsen, reached the pole and returned safely. Scott and his team did not survive the return journey. They were both sent from, I think, by the Queen. The difference was not courage. It was preparation for extreme conditions. Institutions rarely fail because average conditions deteriorate. They fail because extreme conditions were never built into the design. Next slide. Third distinction feels particularly relevant for African businesses today. Over the past few years, we have seen global liquidity conditions evolve, interest rates, environments recalibrate, sovereign refinancing discussions test market confidence, including here in Kenya, where I think has been presented currencies, interest rates across the region, including across the region, experience periods of volatility. None of this is abnormal in emerging markets where we operate. So generally, you will see cycles evolve, risk repriced, and CFA shareholders are really into that, and capital is reallocated. So the question is not whether volatility will occur, but it will. The question is how we will steward risk and capital while preserving confidence. So I'd like to just mention a few principles that I'd suggest. First, a risk is not the enemy. Mispriced risk is. I think we've heard about the central bank giving a base rate, and then a risk margin is added into that. And you're very good. I'm an actuary myself, so I think we share common things with CFS. And the beta, you're always able to determine the beta. So risk is universal, but what differentiates institutions and markets is how risk is understood, priced, and governed. Markets do not really collapse because risk exists, but they destabilize when risk is ignored, obscured, or politically deferred. And liquidity on the other side tightens not only when capital becomes scarce, but when confidence retreats. This is really important for people who run private businesses like us. And across our region, we have navigated periods of debt restructuring discussions, credit spread volatility, currency repricing, and currency recalibration. So yet, what we have seen is capital flows continue to come, and they flow towards institutions where governance is credible, disclosure is consistent, and balance sheets are very transparent. So investors do not really fear volatility. They fear that opacity that I've just mentioned. So risks must therefore be measured, priced, and acknowledged, and not hidden, not deferred, not politicized. Second postulation I was looking at is capital discipline is strategy in running the businesses, and as yourselves, capital allocators. In expansionary cycles, capital is celebrated for how quickly it is deployed. In evolving cycles, however, capital reveals character, and balance sheets do not lie. I like the fact that the central bank is really pushing for even stronger balance sheets for the banks. as in insurance sector, we've had something like that before, and we expect that there will be more stringent requirements in capital. So in our markets where cost of capital remains structurally higher and liquidity thinner than in advanced economies, discipline is not optional. Next. It's like, we are not all runners, but in Kenya many people associate with running. So at sea level you can sprint. You go to Mombasa and other places in the lower altitudes, but at higher altitudes survival depends on pacing, reserves, and preparation. So during periods of significant currency repricing, institutions with disciplined foreign currency, for example, and diversified funding structures are better insulated from volatility. So our thinking is capital discipline means maintaining liquidity buffers that feel conservative in good times, but also it means managing currency mismatches deliberately and sequencing growth so that in expansion, this expansion after, when the stability returns, and then your innovation also is enabled, because without capital you don't have so much room to innovate. Governance is strengthened and even encourage stress testing. So capital allocation is not just about optimism; it's about judgment, and perhaps most importantly, being humble and humility before leverage. So history, I think, if you look, rewards organizations that survive full cycles, and not those ones that actually accelerate fastest at the peak. Finally, confidence for me is something that I've also been asked to include in my presentation. It's the most valuable asset in my view on any balance sheet. And confidence cannot be audited. It does not appear in equity. But once lost, it's extraordinarily expensive to rebuild. I think we've seen businesses that have collapsed because confidence by investors has been lost, or customers, or internal stakeholders. So investor confidence, for example, rests on the credibility of the level of disclosures and consistency. And I think that's where most of the CFAs belong to, in the investment side. Then we have the customer confidence that tests where you're fair and integrity. So, for example, for the banks, this issue of transparency in pricing and loan and interest rates. And then the internal confidence rests on the leadership, how leadership is viewed, how steady and consistent it is. So confidence eventually lowers, in my view, the cost of capital, and its erosion raises it, and it will be seen in the pricing. In all these, what transforms is into instability when you have all the cyclical things that have been mentioned, or all the volatility, is the confidence. The confidence, I think that, for example, the central bank has shown us in managing the shilling, the interest rates, and the inflation, has given a lot of stability into the economy, just that confidence alone. So in East Africa today, we are seeing both pressure and progress. So we see a lot of fiscal recalibration. We do business in Kenya, Uganda, Tanzania, DRC, and we see that there's a lot of fiscal recalibration in different formats, stronger regulatory scrutiny, stronger and very accelerated financial sector innovation, and deepening domestic capital pools through both insurance, pension, savings. So these are not signs of fragility, but they show that our economies signs of maturation of institutions. So finally, just to summarize all this, is that is the long-term value that we should seek as private institutions and investors, such that in volatile environments, we steer very strongly in a managed growth format, and the issue of freezing investments. For I think companies, we've seen freezing investments in periods of uncertainty, but operate in a way that is less defensive. So strong leaders, in my view, distinguish between panic and prudence. At AR, for example, we have grown tremendously, even in times of volatility, but in a very calculated way, bringing us to a very strong financial, position, raising confidence for customers and stakeholders and our regulators. So resilience for us, build before storm and not during it. So finally, if we govern risk transparently, allocate capital responsibly, and lead with steadiness through volatility, our markets will not merely survive, but they'll thrive. And that is how enduring institutions, in my view, are built. So I did not go through the rest of the slides. I think I have 2 or 3 more. But thank you so much, CFA Society, the President, for your invite and for allowing me to present and for listening tonight. I wish you a good evening and very successful rest of the year. I think we're still in Q1. So thank you so much.
Thank you, Mr. Justin, for giving us the private sector perspective. I think we only have 2 items, then we can go for dinner. So I think in the interest of time, I'm requesting the next presenters, the next presenter and the panel discussion to be conscious of the time. Our next presenter is on, we'll get a technical address from the heart of the banking industry. To understand this, how the forecast will translate into actual lending environment, please help me in welcoming the Director of Research and at the Kenya Bankers Association, Dr. Samuel Tirongo. Karibu.
Thank you, and good evening. I want to also stand on the same protocols that have been established. Governor CBK, Dr. Kamau Thuge, President and Chairman of TDB Bank, Masud Tadesse. I hope I got it right. And Mr. Okumu, CEO of AAR. I bring you greetings from the other side of banking. I know the governor was here and he looks after all of us. So one part of it. So in terms of speaking to the issues that have come up today, and of course the forecast point for today, there's a risk that I might repeat some of the things that the governor has said. And there's one exciting thing with repeating because it must be then the truth. So on the monetary policy side, as we see it from the banking sector, credibility has been restored. And I think I must emphasize that part, that credibility has been restored. There was a long period when management of the monetary policy, for lack of a better word, monetary policy was kind of muted in terms of its impact on the market. But from 2023, as the governor did mention, the reforms that have been put in place have actually triggered very strong credibility. And that, when we look up at the interbank market, which is where everything begins, because it starts at the interbank market before it actually transcends to the rest of the lending rates in the market. So I must thank the central bank really for instituting very critical reforms. And all these reforms have actually been triggered by a partnership, central bank having conversations with the market and knowing the pain points that the market is going through. And of course, even on the FX markets, the challenges around liquidity availability were felt, but it took a central bank that actually is reform-oriented to bring in measures that really unlocked the market. And now we enjoy a market that is well-functioning, and we could see the indicators that we have. Now we have a very strong market, as we say. The core capital, the total capitalization, like the capital adequacy ratios in the tune of 19% against a minimum of 14.5%. And even still, the forward-looking component is looking at strengthening that even the more with additional capital injections in the market. And the central bank governor did mention about this, that we're looking at the future, preparing for the future. I remember during COVID, there was a lot of worry in the market that things would go down, and the government took measures, emergency measures to support the market, even including the central bank announcing suspension of provisioning for expected credit losses. But you know what? What happened after that? Actually, the market still continued to make provisions for expected credit losses, meaning we are strong enough to survive massive shocks that may come. And I know shocks continue to come in various forms, in unique ways, but for us, as we build a stronger market, beyond capitalization, liquidity ratios at more than 50%. So in terms of meeting any maturing obligations, the market remains very strong. On the confidence side, we look at it from two sides. Of course, there is the FX side. Now, the governor mentioned about more than 5 months of import cover, and even reserves going beyond 12 billion US dollars. That is an indication. That gives confidence. Even those that are holding and trading these FX in the market, when they see those numbers coming out of CBK, there is a lot of confidence that there is a very strong buffer that the country has. On the confidence side also, what we've seen, the reforms in the liquidity management at the National Treasury, we had a big scare in 2024 when there was maturing Eurobond, and everyone was scared. And at the same time, I think we saw a downgrade of government. And following that, I think 4 banks also were downgraded in terms of their rating because of exposure to government. But the innovations that have come through from the side of government have actually managed that process and restructure the facilities to such an extent that the market now does not even discuss about risks associated with the Eurobond maturities. It's not a subject of discussion anymore. That's a sign of very strong confidence in the market, and optimism is at all-time high. And all this definitely speaking to the current management of both fiscal and the monetary policy, monetary authority at the time. Now, when you look at the capital flows, Kenyans are unique on the side of diaspora flows. There was expectation that around COVID time we would actually have a dip on the remittances that come through because we expected that there's job losses out there, but those have remained resilient. So on the external side of our books, we actually see very strong inflows coming in. We only worry about what happened in 2024 when the country was grey listed. And last year when Europe actually enhanced monitoring on Kenyan financial sector transactions. So I know there are reforms. And one thing that I must emphasize also is the fact that the grey listing of Kenya is nothing to do with banking. I think it has to do with the conclusion of cases associated with money laundering. And the world wants to see those conclusions. So it has something to do with judicial processes, how long they take, and the management of non-financial sector, the non-profit organizations funding associated with that. So in as much as the banking sector now faces a higher scrutiny level when it's looking at transactions through Europe, that's the concern that we have. But we've not yet seen that affect the capital flows into the country. So I know we're putting in measures, discussions with the Financial Reporting Center and all the reforms that need to come on board, even inclusion of lawyers as reporting agencies that has now been effected through. So all these reforms are geared at safeguarding this future. The forecasts that we saw from Professor, that's looking very, very good. How do we safeguard that forecast that we have, the credibility that has been sustained for a stronger growth? The capital, as we see from the banking side, the capital flows coming into the country, particularly for own lending, is now becoming much more sensitive to price. And it's a good coincidence that we're talking about price reforms. We're seeing it, I think CEO AR mentioned about a lot of demand for looking into governance structures within institutions that we have. And it's also out of this that we are strengthening our call as an industry to transition to the ESG platforms, the environmental and social and governance platforms. And the central bank, again, working together with the industry, has been able to champion for the transition and even inclusion of climate risk within our risk management frameworks. And now banks are geared to report more on the exposures to climate in the banking sector. So a lot more disclosures are coming in, opening up the space from the conventional disclosures that we've seen, now moving into the space of green portfolios, moving into the space of what is exposed to the climate, the vagaries of weather and all that. So when we look at the market now, I think all is geared up for a stronger growth. With the reduction in interest rates that we're seeing, we've been challenged by the governor that we need to pass through the full length of the CBR cuts and all the reforms that are coming in. Of course, sometimes when something is new, there are usually some jitters here and there on resistance to change. That is very natural. But we expect that to improve going into the future because all banks now have transitioned to a unified base rate. And I think in terms of transparency in pricing now, competition is only on the premium that is loaded on the base rate to form the lending rate. And customers, and we're making even efforts to publish each bank's lending rate. In fact, in essence, we're publishing each bank's premiums that are loaded. So competition is expected to pick up. And even beyond the CBR cuts, we may actually start seeing even cuts beyond the CBR cut, like for instance with the 400, we may see in the future actually seeing banks going all the way to 400 plus basis points cuts because of competition that has now been triggered. So disclosure is working its way, competition is kicking in, and of course the reforms that are coming in that are very progressive. Allow me before I end again to re-emphasize on the partnerships so far found with the central bank in terms of ensuring that the market moves forward in supporting the rest of the economies. And of course, we acknowledge that now we have about 8 or so banks that have spread their wings from Kenya into the region, some even moving into Central African countries, and some considering even to go all the way to West Africa. Now, as we integrate into the region, the other day we received calls from the Bankers Association of Tanzania. They're saying, we've seen Kesonia, now we're looking at the possibility of Taonia in Tanzania. So they are just monitoring the implementation. They said, we want to learn from your experiences as you transition, so that if there are any adjustments that are coming on board, for us, we wait and then we go with the refined product as we engage this. So they're already having conversations with the central bank, the Bank of Tanzania on the same. So Kenya is becoming and has actually strengthened its position as a thought leader, as the hub in terms of not only market transactions but also policy reforms that we see. Without much ado, I now stand between the supper after this dinner. Thank you.
Thank you, Dr. I'm told we need to have dinner by 8:30, and Medics say that we are not encouraged to eat dinner late. So I'm encouraging my panelists to mount on stage, and please, maximum of 10 minutes.
Thank you, Cliff, for giving me all that pressure. Good evening, all protocols observed. My name is Yvonne Munyambo. I have the pleasure of dashing through the next session, which is a panel discussion. Allow me to call on my guests or my seasoned panelists tonight. I will skip the introductions. As we have been told, I am between your very scrumptious meals, so I will ask them to come onto the front, please. Thank you. So we have Faith Omange, Alex Rithi, Mwathi Kilonzo, and Humphrey Gathugu. And we'll start this from where all great investment stories start. That's the macroeconomic environment. And we've been given very good insights on how our macros are stable. But Mwathi, I feel like global macros at this point are behaving like that unrelentless cousin. They're charming at one time, and the next they're alarming. So we're seeing what is happening on the global front. There's central bank easing, but then there's geographical defragmentation. What does that mean for us as we are looking at the Kenyan environment?
Can you hear me? Oh, yes. Thank you for the question. I think what we're certainly seeing is a reversal of the very tight conditions we had for the last, if we go back to say when we had the FX issues. So as that eases, and as global conditions ease and the US market becomes a little bit more tenuous or a little bit trickier, what we're seeing is that emerging markets are becoming a lot more interesting. So I think the wall of money, I don't think the wall of money that used to be there will come back in its full entirety, but certainly these markets are starting to become a lot more interesting. And I think when you have, think what you think about the valuation of KPC, but ultimately an $800-900 million raise is enough to attract anyone's attention. So if I were thinking forward, I would be expecting that KPC would be a candidate for MSCI inclusion maybe in November, which now attracts people, which starts to make it a lot more interesting. So I think that the market is certainly allowing us some nice new investment opportunities.
Thank you for that. So we move on to the next element as we think about investments, which is currency risk. And we all know currency risk is that silent guest at every investment dinner. We don't see them, but we feel them, especially within the African landscape. So Faith, this is to you. How do you think investors should then balance the local and hard currency exposure in 2026? And does that change perspective as we see a lot more stability in the African context?
Thanks, Yvonne. In 2026, unlike what we had in 2023 and beginning of 24, I think investors now start looking at currency as a mode of diversification as opposed to a trade. So this local currency, and when I talk about local currency, I'm talking about the regional, the three large East African countries. We do not expect investors to start looking at currency trade as a trade idea, but more of a long-term strategic diversification tool. In practice, this basically means that I would favor a core allocation to local currency assets and maintain a strategic sleeve to hard currency exposure. But then as we talk about hard currency exposure, it has to be quality hard currency exposure because people have burnt their fingers on hard currency exposure. So quality hard currency exposure, but maintain their core allocation to local currency assets. If the governor has said anything tonight is something to take home would be how the stability is looking, the FX stability is looking. So no longer a trade, but more of a strategic diversifier. Thanks.
Thank you, Faith. And speaking of hard currency and product evolution, I'm sure you can all agree. We've seen a lot of USD, CIS funds evolution. I think they're evolving more than coffee shops in Nairobi. I'm sure you can relate. So my question is to our governance compass tonight. That's Alex Rithi. With all this evolution, are we getting a sense of getting our investors more financially aware? And to us, especially as professionals in this room who serve those investors, what more can we do from an accountability, from an awareness perspective to support that journey?
Thank you. I think one of the greatest risks that has not been discussed in this room is financial literacy. And right now, those of us seated here understand those big terminologies we are discussing here. But the ordinary Kenyan out there doesn't understand this jargon that we are discussing here. And therefore, when we look at now the investments that are coming our way, there is need for us to tone down the messaging so that everybody understands what we are discussing, so that then their choices of where to invest is informed beyond the rhetoric that we are receiving out there. And those of us in this room are the ones that are going to help those of us out there, because I represent the Kenyans out there who are not very well informed. So there is need for us to see how do we improve our financial literacy to Kenyans who are supposed to be our investors. And also, we should not also ignore the small investor who has a few shillings. Let them understand that whether it is a Kenyan denominated or these foreign currency denominated investments, what do they mean to them, and how do we ensure that whatever they invest in is properly governed and they are aware of the risks that are involved.
Thank you. So food for thought, all investment professionals as we are, to ensure that we're disseminating this. And finally, on private markets and alternatives, we have seen them, we've talked about them, but the commitment, are we there yet? So to Humphrey, from a private market perspective, where do they fit on the institutional portfolio this year? What's realistic for the regional context? And maybe you could talk about crowding out effect of the government, if there is.
Thank you very much. Certainly, there's been very little allocation to private markets, to alternatives, to private credit, but we've seen this growing tremendously, and I take from what Alex has said about do people really understand what we're talking about. But be that as he said, yes, there's some allocation to alternatives. Let me just call them all alternatives. And the push for that is really diversification. It's really to have assets that are very, very lowly correlated with traditional listed assets. You'll see low volatility coming in. But the adoption of these assets, I think, will take time. One, not because of a lack of professionals, and we've seen, a lot of professionals, be they CFA, CFA coming through. It's more of the absorption capacity. Are funds ready for this? Do we have enough, say, PE funds in second, third vintage that are really available? And also the other advantage of this asset class is that it gives you access to themes, to strategies that are not necessarily listed. If you look at the companies listed on the stock exchange, you'll see it's not really representative of the Kenyan economy and of the regional economy. So by going through private credit, private equity, alternative assets, you're then able to access certain sectors that you may not ordinarily access through, listed alternatives. To the question of crowding out, I think there's been enough talk this evening about, reforms that have taken place, about transmission of policy, the corridor, and of course, Kesonia. Hopefully we'll see a lot more of that going forward. But also we must understand that we're in a relatively high interest rate environment, and what that necessarily means is that when you've got double-digit bond yields, it means that everything else has to perform a lot better for you to allocate away from what is seemingly a very, very safe and secure asset. So as we see interest rates trending downwards, then naturally you'll see the real economy coming in, and we'll see banks also allocating more and more to the real economy as opposed to, your government securities. Thank you.
Thank you, Humphrey. And with that, we hope those nuggets of information allow you to allocate with conviction and responsibly in this new year. Not so new year anymore. And I sure hope we deserve a round of applause for saving you some minutes for dinner.
Thank you, Yvonne, and thank you for the panelists. We've come to the tail end of discussion this evening. Just before I invite Annette Mumbi to give us the vote of thanks, I need some help from the IT team to have, there's a QR code that's supposed to be running. Thank you. As she gives us the vote of thanks, I'll want you to take your phones out, scan this QR code. We want to test how good you are at forecasting. You know, the last 2 weeks, the weatherman gave us an advisory that we expect quite substantial rain. We've seen it come through. And you know, it's only in weather forecasting where you can be 100% wrong, but still maintain your job. So we'd like to see how good you are at this. For the CFA Society members, we will reward the 3 best forecasters at the next session next year. So try all your best. Thank you.
All right, distinguished guests, members of the CFA Society and the Trade Development Group, good evening. So mine is just to give a quick vote of thanks. So I'll list out the speakers in order, and I'd like you to give each 3 claps so that we can finish this, right? And so in absentia, I think John is out. So in absentia, let's appreciate Mr. John Okumu, the chair of the CFA Society. 3 claps. So let's do it again. Yeah, perfect. Next, Mr. Adamasu Tedese, the president of the TDB Group. Ms. Dr. Kamau Duge, the governor of Central Bank of Kenya. Professor Victor Murinde, the executive director of the Africa Economic Research Center. Mr. Justin Koskei, the CEO of AAR. Dr. Samuel Chiriongo, the Director of Research and Policy at the Kenya Bankers Association. Our panelists of faith, Yvonne, Humphrey, Mwathi, and Alex. The CFA Society of East Africa for organizing this. The Trade and the Development Group for hosting us. The MC, Cliff. The media team. And a round of applause for ourselves for making the time. Thank you very much.
Thank you, Annette. We've come to the tail end of our event. Thank you for all of you for honoring the invite and coming up. So we are now proceeding for dinner. So the guidance is that as you leave the hall, towards your right, I think there are lifts. You'll be guided on how to go to, I believe it's that floor? Yes, yeah, thank you.